Good evening, everybody. Welcome to the PepperClub webinar this evening. This is our second webinar that we're having, and people invited to come and ask questions and listen to the presentation on the PepperClub. And so we welcome you here tonight. Welcome the webinar people who are watching us. So on behalf of the board of PepperClub, Grovest and the Solomon Brothers, we welcome you. Tonight we're going to go through like a question and answer session. I'm going to ask a whole lot of questions to Amaresh, who is the fund manager. So welcome, Amaresh. And Amaresh is also a director of PepperClub, so he's very, very well versed in the PepperClub and can answer a lot of questions. Just a little bit of housekeeping. There's toilets outside to the right, the men's just down the passage, and the ladies in the far corner. And there's some food and snacks and some drinks, which you're very welcome, and we encourage you to stay after the event so we can mingle with some of the fund managers, so we can ask, you can ask any questions that you may require. Okay, so just to start. PepperClub is a Section 12J investment. What is Section 12J? 12J is anybody who invests into a Section 12J registered company with SARS and with the FSCA is entitled to 100% deduction of the investment amount from their taxable income in the year in which the investment is made. So if you invest R1 million into the PepperClub, the PepperClub will issue you a share certificate for R1 million and a tax certificate for R1 million. You can then use a tax certificate to deduct when you're filling out your tax return, and it comes off directly off your taxable income. So should you be paying tax at the marginal rate of 45%, you'll get a 450,000 Rand benefit immediately, and any PAYE or provisional tax that you may have paid will be returned to you once your tax has been assessed. So what is taxable income? So I had a lot of questions about what is taxable income. So taxable income would be the cumulative of the amount you receive as a salary. It could be interest that you receive with money that you have on fixed deposit. It is rental income that you may receive from a property that you may be renting out. And it could be profits or capital gains that you made on selling a property or sale of shares. That all adds up to be taxable income, and that you would then be able to use your investment that you have in a Section 12J against the total of your taxable income as a deduction. So that gives us some sort of background as to what is Section 12J, what is taxable income, and what we will do is I will ask Amaresh a couple of questions on 12J, but I think before we do that, let me just tell you a little bit about Grovest. That's where we are today. Grovest is a boutique corporate advisory house. It was the first operational Section 12J in the country. This is going back 6 years ago. Fast forward 6 years later, today there's probably 170 odd Section 12Js registered with FSCA and SARS today, of which Grovest has 10 of its own funds, of which the PepperClub is one, which it is a promoter. And it manages about 44 funds on behalf of third parties as purely as administrator. So we have been very, very active in the Section 12J arena. We have lobbied the various parties, whether it was Treasury, whether it was SIPC, whether it was SARS, and invited to the Davis Commission to assist with questions about 12J. And after lots of legislation on a very, very immature act, we are where we are today. And Section 12J in its own right has become an asset class by itself. Today there's probably about 8.5 billion Rand invested into the 12J asset class. and we anticipate at the end of this February 2020 that the amount should exceed 10 billion rand invested. So without any further ado, I'm going to actually ask Amaresh, maybe you want to just introduce yourself, explain what you do for PepperClub, and then we can pick up the proceedings.
Good evening, everyone. Thanks for coming along. Thanks for the introduction, Jeff, and for having me here. So I'm a director of PepperClub, as Jeff says, but also the fund manager, which means I'm largely in charge at this point of the fundraising efforts, meeting investors, investor relations, and also the underlying asset, which I suppose we'll tell you a bit more about when we get through the slides.
Yeah, great. So should we play a video? And maybe
yeah, let's do that.
It'll set the scene. I think what we're going to do is we're going to let's talk about the promoters of PepperClub, who the directors who sit on the board.
Okay, so let's start at the far right with our non-exec chairman, Mutle Mogasi. Those of you in the finance world are probably familiar with Mutle. He was the co-founder of Vantage Capital, which probably runs 8 billion rand under management. They probably the premier provider of mezzanine funding in the city or in the country. Next to Mutle, we've got the brothers, David and Jeffrey Solomon. They're two of three brothers. There's a third brother, Irving. David and Jeffrey were involved with two previous property listed companies, the Arnold Property Fund as well as Redefine. They've got in excess of 40 years in of experience in property. They were founding directors of the first Cape City Improvement District. Next to them you have Jeff Miller, who's sitting next to me. Jeff's a serial entrepreneur, he's a startup expert, he's started a number of businesses. Well, I'll just talk about one perhaps. Jeff was co-founder of Brand Corp, which was listed on the JSE and then bought and delisted and then sold on to Bidvest. Next to Jeff is myself. I've been involved in a number of empowerment deals in the real estate space. Most recently I was involved with the National Lottery. I helped put that bid together. I was a director of that. And I think probably I should point out that everyone's got a lot of property experience and definitely capital markets experience. When we get to the exit, we'll talk about one of our exits potentially being a JSE listing. Everyone here has got adequate experience for that potential liquidity event.
Okay, great. So thanks, Amaresh. I think the board, as you said, is very, very qualified. But I think what is deserving is to actually talk about the promoters of this particular project, which is the Solomon brothers, And let's, I think, give a bit of background about the Solomon Brothers Group.
Okay, so so the active management is done by the Manco. You'll see in the info memo, there's a Manco that sits alongside this.
So generally in the structures of VCCs, the VCCs don't employ any parties. There is a management company that sits alongside it, and the management company employs people and who actually manages the VCC as well as the qualifying companies.
Okay, so
Yo,
should
go
I
ahead
pick
and
up with
with
the experience?
Go ahead with tell us about the Solomon Brothers Group or SPG.
So the Solomon Brothers Group, as I said earlier, has got mine's got a green light.
No. They're mainly for the webinar. They're not for so they're for the guys watching us. So, Amaresh, I think the message was please speak up.
Okay. So listen, the Solomon Brothers have got a deep and rich track record in real estate. They've across all sectors: industrial, hospitality, office, retail, residential. Some of the properties that they have in Cape Town, which you may be familiar with, I suppose probably the one most people would be familiar with, is the shopping center in Camps Bay, the Promenade Mall where all the restaurants are. So that's one of theirs. They've got the Advocates' Chambers near the Cape Town High Courts. There's another property which is part of the pipeline of this asset, that which is called the Versailles. It's a building in Greenpoint, just opposite the gym, so sort of behind the lighthouse. So they've got a significant property portfolio that does run into billions, and 40 years of experience doing this.
Yeah, so I must say that if we have to go back and talk about property experience, that the three brothers, the Solomon Brothers, which form the SPG Solomon Brothers Group, have had 40 years of experience, mainly investing in the city, both on the promenade or Atlantic Seaboard and the inner city of Cape Town, redeveloping various precincts. And they were the founders and have built this particular hotel 10 years ago. So maybe you want to talk about the history of the PepperClub.
Sure. So it took them a few years to assemble the site. It's this hotel's built almost on almost an entire city block in the middle of Cape Town. I'll talk about the location in a bit. But it opened its doors to the public on the 15th of March 2010, so it's got a roughly 10-year track record. Some of the financials are summarized in the info memo, but they've been profitable every single year since opening. They've run an average of 60% occupancy through that time. There were 2 years probably when it dipped below 60. That was when Cape Town had the drought, but those financials are in the info memo. Even in those 2 years, the hotel was profitable and no capex was held back, in terms of maintenance and refurbishment and the like. The building itself is built over 22 stories. It's 200 hotel rooms. It's got everything a five-star hotel would have. It's got a spa, in-house cinema, restaurants, a pavement cafe, pool, obviously. I'm trying to think, I'm missing something.
Cinema.
No, I said the cinema. Yeah, the gym. Thanks.
Okay, yeah, so listen, it's a full five-star hotel. It's actually won awards for the last 7 years as the best inner-city hotel in South Africa, or maybe even Africa, and actually in Africa. So it really is a well-appointed, serviced hotel. Food is good. The rooms are large. I've stayed there a number of times in different rooms. Every single room comes with a bedroom. Obviously, it comes with its own separate bathroom. It has a separate toilet. It has a little lounge or big lounge and a kitchenette. So with a desk to do some work in. So that is, even in the smallest room, that is what you would get. And I must say, very well appointed and no expense spared in the linen and all the rest of it. I actually love the linen. Okay. Okay, let's get into the nuts and bolts. I think we've discussed the hotel. We understand. Where is it situated?
So it's on the corner of Loop and Pepper Street. So one up from Long Street, in other words, where all the nightclubs and nightlife is, and one down from Bree Street, which is full of really nice restaurants. It's a good location. It's a few minutes, 10 minutes, call it, to the waterfront, Table Mountain, Camps Bay. Yeah, it's nicely located.
So it's very well located. It has got great views. I think we saw some photos of some of the vistas. But also they have a shuttle that runs every hour or half an hour that goes to the beach or to the waterfront, to the shopping center. And at the beach, they have what they call a beach club, where one has lockers and showers and all the rest of it, where all its guests can be made comfortable as well. So let's, I think more importantly, I think we know that it's a great hotel, 5-star hotel, won awards, all that type of stuff. But the guys want to know more, a little bit about, let's talk about the commercials. Okay, so let's get into the commercials. We spoke about, we spoke about that there's a 7.6% average yield. Can you talk to, tell us more about that?
Okay, so when I talk about the 7.6% yield, okay, the hotel manager, the Solomon Brothers hospitality entity, will guarantee a yield of 6.5% in year one, and they'll guarantee 8% escalations per year for 4 years after that. SARS requires you to hold these shares for 5 years. And what I'm going to talk about after this is our unique funding structure. Jeff's told you about 170 VCCs. We're the only guys that can offer you the funding structure I'll speak about. But the reason that funding structure can work is because of the underlying yield that has been guaranteed. The 7.6% is a simple average of 6.5 with its escalations over the 5-year period. It's worth pointing out that 7.6% is the average on 100% of your capital. So if we were talking about the return on your risk capital, once you've got 45% back from SARS, you're talking about a return well north of 13%.
Yeah, so thanks. So just to give you just to help you again, is that that means that the operating yield would be the profit before tax, which the hotel would actually make on an annual basis. The company or the hotel would then pay tax and distribute dividends to the various shareholders. That 7.6% average is guaranteed by the Solomon Brothers Group, and there's a holding company guarantee. That means that to the extent that the hotel in any year did not perform as per what is required, commencing at 6.5%, growing at 8% per annum, they would top it up out of their own resources to ensure that the investor, which is you guys, would get the guaranteed return.
That's correct. That's good.
Okay, so, all right, so let's talk about
the funding structure. Oh,
well, yeah,
okay.
Funny struck. Talk about. I'm not superstitious. Go. We'll get to all the questions.
So what we're happy to do is give subscribers 100% loan. The funding sits with us, so we're not going backwards to a financial institution and showing them your paperwork to work out whether you qualify for a loan or not. We'll approve that in these offices, and that's based on the strength of the underlying asset. So when we tell you there's 100% funding, we give you two loans, a 45% loan and a 55% loan. The 45% loan is a bridge loan. The 55% loan is a term loan. The bridge is matched to roughly when we would expect your tax refund to come back. So, e-filing would open in July. You would expeditiously put in your return with the VCC certificate that we'll issue, because ideally you would have subscribed for shares now in this week or next week. And Jeff ran through the mechanics of that a little while ago, so I won't go through that. The point is, you'll then get a refund of, on that R1 million example, if you were in the maximum marginal rate, 450,000, which is what you would use to settle the bridge loan. The term loan we leave outstanding for 5 years. According to our model, there'll be a small difference between the funding costs and the dividend that you're due to receive. We don't expect that to be serviced. If you want to, you're welcome to. The loan is completely uncommercial from the point of view that if you want to settle early, there's no penalties for early settlement. We don't want the present value of what we would have earned if the loan had been outstanding. You completely at liberty to settle that.
Okay, so just to recap, there are two loans. There is a bridge loan, which would effectively bridge the tax that would have really been paid by the investor by way of PAYE or provisional tax, and that would be so they would the SPG Finance would lend you R1 million in two loans. One would be, assuming you're lending R1 million, one loan would be 450,000, which should be repaid when SARS return your PAYE or your provisional tax that you would have already paid within 6 to 8 months.
That's correct.
Right. Yeah. And then the second loan, which is the term loan, which is a 5-year loan, which would be the 550,000 rand, would be loaned to you on a 5-year basis, that at prime, which is 9.75%, which may fluctuate up or down over that period, and less the guaranteed dividend or yield that which the dividend would be declared, would be set off against that interest, and after 5 years, that 550 would probably, assuming that only the minimum guarantee has been declared as a dividend, that would roll up to about 620. Is that correct?
That's exactly right.
Right. Okay. So that's great. So you're not laying out any money. You are getting money back from the receiver, and then you hold the investment for 5 years. What happens in 5 years' time?
So there's a number of options on the table for a liquidity event. Of course, in 5 years, all our shareholders will be focused on the fact that they've got this 550/620, depending on whether they're geared or not, that's coming due. The board would obviously look for the best deal possible at that time. The best deal may be that a hotel group wants to buy what's a prime hospitality asset in the Western Cape, or a portfolio of them. As I said, we've got growth ambitions for this. The other option is that we don't trade sale it to a hotel group, but we do sell it on to a REIT that's looking for a property asset. If that doesn't come to pass, we could just list ourselves on the JSE, on the AltX. And the last option, which is not mutually exclusive with the listing, is that a key thing I haven't mentioned is we have an independent value on the hotel at 497 million. The VCC is being capitalized on a valuation of 450 million, so you've got a 10% discount in there already. Let's assume that there's no capital appreciation for the next 5 years. The hotel's worth 500 now, and it continues to be worth 500. We could in all likelihood raise a mortgage bond on the property at 250, which is 50% loan to value, and I think reasonable, and return that capital to shareholders so that they could settle the outstanding portion of the loan. But as I said, going that route does not mean the asset won't be listed as well.
So I think I want to amplify the listing story. The intention is to grow a portfolio of about 1.5 billion rands worth of hospitality assets in the Western Cape. So there are two further hotels which Amaresh has alluded to that are on the cards and hopefully will be put into the portfolio by 2021. Is that we would, there's one in Greenpoint, which is that the Versailles.
The Versailles.
The Versailles. And then there's another one in Sea Point, which is called?
That's in the process of being constructed right now, right? It's on. I can give you the location. It's on the corner of Main and Worcester.
It's also got a name, though.
I don't know the name. I don't think we've named it
No,
yet.
no, there is a name. I don't know the name offhand. Sorry. But there's two hotels that are looking to be added to the portfolio. So you as an investor would then be able to or the investment would have a portfolio effect, that you as an investor in the VCC would then be a shareholder in the full hotel portfolio. I'm positive that if we can build a portfolio of 1.5 billion, the natural exit will be to list on AltX. And we Grovest has been working with the JSE for quite a while, and it's come to pass that now that all the approvals have been received by the JSE, that we can list the VCC under the AltX section on the board, and a separate section for Section 12Js. So something obviously that all Section 12Js are able to do, but I think in order to get the proper
Scale.
so you need critical mass. So this makes sense. We know that hospitality is a big driver in South Africa. It's a big job creator. And we also know that South Africa is looking to generate a lot more tourism. I mean, just to give you a side little note, that South Africa is expected to receive 10 million visitors this year. Australia gets 40 million visitors. And I can tell you that South Africa is far more beautiful than Australia. It's got much more to offer, and that's obviously where we have to focus as South Africans, and which is very much in keeping with the growth plan of government. Okay, so just what happens if now there's also, which I understand, the investor is also given a put. So now, sorry, there's another drought or something, Table Mountain
They
implodes,
change the constitution.
or something. What is that put?
So we give you a put agreement to sell your shares back to us at 55% of the subscription value. So assuming you've bought R1 million worth of shares, the first 450 has been subsidized by SARS returning your taxes to you. So what you're really at risk for is 550,000. We give you a put for 550 because, as Jeff said, maybe there's a black swan event. Maybe they do change the constitution and property rights and people are queasy about it. We'll give you a put to take those shares back at 55% of the subscription value, so you're not really at any risk.
So just to clarify, that put is only in the hands of the investor, doesn't belong, so
there's no reciprocal call.
There's no reciprocal call. It's only a put in the hands of the investor, which he can exercise after the year 5, so the full tax benefit would have been received. So they would have received the 450 tax benefit, and then they can put their shares back at 550, so effectively they're absolutely neutral. So in 5 years, they haven't made any money, they haven't lost any money. In fact, they would have actually received the dividends, and they would have got bed nights.
Correct. I was going to say, that's exactly it. There's an arbitrage on our bed nights because for every million you put into the VCC, we give you 6 nights at the hotel, and there's a great chance you'll get your 6 nights because there's only 2 blockout periods. We can't give it to you the first week of Feb because of the mining in Durban when the hotel runs 100% full, and we can't give it to you from the 20th of December to the 10th of Jan. But school holidays, long weekends, the August, the Jazz Festival, none of those are blocked out. You can go to the hotel and use your nights.
So am I right in saying that you can use those nights in perpetuity for as long as you're a shareholder in the business?
Correct. They don't. If you sell the shares, those rights are not transferable. It's only for the original shareholder.
Yes.
But correct. If you don't sell the shares, you continue to enjoy the nights. It's probably worth pointing out that if you don't sell the shares, by the time year 6 rolls around, I think your dividend is something like 17% on your historic cost. And of course, you won't have the CGT event arrive. So there really is an incentive to hold the shares.
Okay, so let's go to the structure of this investment. So I do know that a tax opinion has been obtained to confirm that the PepperClub Section 12J structure is compliant. Do you want to talk about that a bit?
So we've got an opinion from Advocate AJ Murray in Cape Town that confirms that offering the funding to make this investment is completely within what's allowed. And we have a confirmatory opinion from an advocate, a senior counsel, Milton Seligson, that says that this is also that he agrees with the first opinion. So yeah, it's completely robust.
So the tax opinion, there is a tax opinion, and it is available should anybody wish to have that tax opinion on file. We're happy to circulate it and share it with you. It's just also interesting, just a side point, to the extent that, and also came out in the tax opinion, so if anyone doesn't have a R1 million taxable income in this year, and let's say they have 800,000 rands worth of taxable income, and they invest R1 million, they can carry forward the shortfall, i.e. the 200,000 to the next year. So it is available to be carried forward. And we have a tax opinion to that effect as well. Okay, so let's talk about, I think what's important is we talk about the cash flow. So let's look for the cash flow. There. So can we talk through this cash flow?
Yeah, sure. So, okay, so I'll obviously start at the top left and work my way down to the bottom right. What we're saying there is your investment is R1 million. The tax benefit of 45% is the 450 that's come back. The gross dividend of 43,200 is calculated as 6.5% less a 0.5% fee, which is what the Manco charges. So you're actually down at 6%. And you get to 43,200 because you've got to take off the dividend tax. The numbers that run alongside that are year 2 is year 1 times 1.08, and so it carries on until year 5. The return of capital is a number that we calculate by saying the initial million should have escalated by 6% a year to 1.3, and then we take off a performance fee.
No, capital gains tax.
No, the capital gains below it. Okay. And then, of course, we work out the capital gains tax. And basically what it ends up at is you're 635,000 Rand up on a basically an IRR of 18.6%. But the key thing to point out here is under this scenario, I was going to say the key thing to point out here is you've not put any money up, but on this one you have put the money up.
Well, this is assuming that there's no loans.
Yeah, correct.
So assuming you got no loans, because anyone can get a financing option, one can go to the bank and get a financing option, but this is a typical investment cash flow that shows that if you invested into this particular investment, assuming that the capital amount in year 5 increased by 6% per annum, and that you held it till maturity, you would get 18.6% minimum return. Obviously, if the 7.6% average yield is greater, then you would get a higher dividend and the return would be higher. Now, what they've also done is they've added in the bed night value using the rack rate. So there is an additional 4% or close to 4% in the RR for the bed night for as long as you hold your shares in the VCC. The top is for investors and the bottom is for companies. The companies are a little different because that you can only get a 28% benefit, while individuals and trusts can get a 45% tax benefit up front. So there is a smaller return in the hands of the company than it is in the hands of individuals. I think also what's important to note is that individuals and trusts are capped at 2.5 million Rand per annum, and companies can invest up to 5 million Rand per annum. So that makes, up in October they changed the rules. Prior to that, you could have unlimited amounts invested into the Section 12J, and now they've put caps on it. So you can, even if you've got taxable income of 3 or 4 million Rand, unfortunately, only 2.5 million Rand can be invested in the 12J where you'll get the full taxable benefit. Is there any questions that anyone wants to ask on the cash flow? Because you write off your investment in year 1, because you invest 100 and now you get the 100, you get 100 back from the receiver, your base cost goes down to 0. So in year 5, or when we return the capital to you, pay capital gains tax currently at 18% on the full amount that gets returned to you.
Sorry, just a follow-up question.
You should repeat the question.
I'm not sure whether you can elaborate on the tax implications. So let's assume you've invested R1 million. At the end of your 5-year period, obviously you need to pay capital gains tax on R1 million.
That's been deleted. That's not applicable.
No, no. Okay, so I'll go through that. We'll have to see. Maybe that you've got a. So, can I repeat the question? So the question is that at the end of year 5, you exercise a put. So the exercise a put, you will receive 550,000 rand back for your put. There is no administration fee. Any other questions?
No, there is.
Okay, the question is there interest on the bridge loan? Yes, there is interest on the bridge loan at Prime for 6 to 8 months. So the quicker you actually, submit your tax return and the quicker you get your refund, the better it is. I also want to point out that the refund comes directly to you, and you have the responsibility then of then passing it on back to the finance company. It doesn't go directly to the finance company. So should you receive it and not pass it back to the finance company, there's obviously going to be interest on that as well.
I think it's also worth pointing out to you, based on that question, that we've modeled out what the total interest over the period is. And on the R1 million loan over the 5 years, we think the total interest is probably on the order of 100,000, and I'll tell you why that is. On that 450 bridge loan, at just simplistically 10%, that's 45,000 for a year, but call it 22.5 for half a year, except it's obviously compounding monthly, the same way a bank would do it. So that's, call it 25, and we expect your 550 to grow to 620, so the delta there is 70, so 70 plus the 25. So the funding costs are really, call it 100 grand over that period for the entire amount.
Yeah, so you also, obviously what's not taken into account here is the time value of money, because now you're getting a 450 deduction in year 1, and in year 5, should you want to repay the loan, you only have to pay back the 620. So there is obviously a benefit by holding it over the 5 years. Yeah. So the question is, you can only exercise a put after year 5. At any time before year 5, if you don't want the investment or you don't want the loan, you can settle the loan. But the reason why the put is only, you should hold it even if you want to exit the investment after year 5, because if you exited the investment before year 5, the full R1 million would be recouped in your next year's taxable income. So you should hold it until year 5 and 1 day, and then the tax benefit is permanent, and then you don't have to put it back. You can sell it. The question is, after year 5, your shares are freely transferable. Like I say, first price for us is listing it on the JSE, on Altex, and then you can sell it on the market where the price will be determined by supply and demand. The listing cannot be guaranteed. The listing would only be guaranteed subject to the environment being conducive to that. And number 2 is that we have, some bulk. So you can probably go to the market with a 500 or 600 million rand asset, but I think the market today is too sophisticated. They want a big chunky type of investments. So that's why we're looking to bulk it up to the 1.5 billion rand mark. So the laws say as follows, that if the VCC lends to so the VCC lending to investor, not a bank or a finance house lending to the investor, it needs to be repaid within 5 years. So this particular loan is not governed by those rules. And those rules say that if a VCC lends it to investor, he has to take on the risk and no guarantees, etc., etc. But this is not the case in the scenario.
Which is also why we got those opinions.
The question is the interest payable on the loan deductible as as an expense in your hands? And the answer is no. It's not in the production of income. But again, it might be, but I think it's not. But I think you might need to ask your tax advisor. Okay, so I think we've covered the spreadsheet. I want to go back to so let's summarize, if you don't mind.
No, of course not.
And speak up so they can hear. That lady at the back there wants to hear you.
So the 6 bubbles on the screen basically summarize the entire investment. If you took the gearing option, and that's not compulsory, you're welcome to put your own money in, then there's no cash outlay to make the investment right now. The reason for that is because, of course, we give you the bridge loan and the term loan. We confirm, of course, that the Section 12J investment is 100% tax deductible immediately. Of course, you would have to make the investment this tax year end, so before next week, or by the end of next week. The funding is guaranteed. As I said to you guys earlier, we're not going backwards to one of the life companies or one of the banks and trying to borrow the money on your behalf. We provide the funding, and we do it on the strength of the underlying asset and its 10-year track record and the underlying income guarantees from the hotel operator and the strength of their balance sheet that backs that. It's precisely because we like the real estate and the asset that we give you the buyback guarantee should you absolutely want some peace of mind that there's a real limit to what you could have at risk. And then we give you these 6 free bed nights. And the reason we can do that is we're raising 300 million. We're giving you 6 nights per million. So on 300 million raised, we'd give away 1,800 nights. There are 200 rooms in 365 days. There's 73,000 nights available. We're giving away 2.5% of the nights. And as I said to you earlier, our average occupancy is 60%, which is why I can say to you, they're fairly reasonable prospects. You'll get your nights if you ask for them.
Okay, says thanks, Amarish. So I think, is there any other questions? Are there any questions from any of the webinar viewers? No questions from the web. Thank you, guys. And is there any further questions from the floor?